Hamilton ETFs just launched 3 brand new DayMAX ETFs that pay distributions every 2 weeks instead of monthly. That's 26 payments per year instead of 12. And I'm currently testing 2 of these in a live $1,000 experiment that could influence a $10,000 investment decision in my main $100,000 covered call portfolio. But before I get into the exciting potential here, let me be completely upfront about something. These funds are so new. They launched in July 2025, which means they have literally zero track record. I'm essentially a guinea pig testing a brand new strategy that could either revolutionize covered call investing or teach me an expensive lesson about why traditional approaches exist. So understand that risk before we dive in. Now, let me break down everything you need to know about these revolutionary ETFs that are using 0 day to expiration options for the first time in Canada. These are Canada's first ETFs using 0 day to expiration options, or 0 DTE if you want to sound fancy. Basically, they write call options that expire the same day they're traded. While most covered call strategies write options once per month, these funds can potentially write options every single trading day, about 250 times per year. Think about that. Traditional covered call ETFs get 12 chances per year to collect options premium. DayMAX gets 250 chances. Even though each individual daily option premium is smaller, the frequency could potentially generate overall better yields. And the first ETF is CDAY. It invests in Hamilton's Champions Canadian Dividend Index and writes options on the S&P 500. It's paying an estimated 18% annually with distributions every 2 weeks. This is the most conservative of the 3 DayMAX options, focusing on established Canadian dividend champions. The Canadian dividend tax credit would be a nice bonus for Canadian investors, making this attractive for those wanting domestic exposure with enhanced income. And really quick, I've noticed 80% of you who watch these videos haven't subscribed. An easy way to support this channel for free is to hit that subscribe button. It not only helps this channel grow, but lets me know you want to see more content like this. Now, the second ETF is SDAY. It focuses on US dividend champions and is currently yielding 17.5% annually using Hamilton's new 0 DTE options strategy. Instead of writing options once per month like traditional funds, SDAY can potentially write options every single trading day. The fund is hedged to Canadian dollars, so there's no currency risk to worry about. This would add geographic diversification since many Canadian portfolios tend to be heavy on domestic holdings or growth stocks. But here's where things get interesting, and that's with the third ETF, QDAY. It targets US technology companies and is yielding approximately 20% annually. This uses the same daily options approach, but focuses on tech stocks, which tend to have higher options premiums due to their volatility. Tech stocks are notorious for their price swings, and QDAY is designed to capitalize on this volatility by writing options against these holdings daily. The higher yield potential comes with increased risk, but for investors who believe in the long-term growth of technology companies, this could be an attractive income play. However, let me explain why these funds could potentially destroy your portfolio, because the risks here are substantial and largely untested in real market conditions. First, there's the untested strategy risk. 0 day to expiration options behave completely different than monthly options. When you write a monthly option, you have 30 days for market movements to work in your favor. With 0 DTE options, you have hours. If the market moves against you dramatically in a single day, you could face massive losses with no time to recover. Traditional covered call strategies have decades of track record. This approach has months, and then there's the amplified volatility exposure. Remember that 20% yield on QDAY? That comes from writing options on tech stocks, which are among the most volatile asset in the market. When tech stocks go up or down dramatically, which happens on the regular, your upside is capped by the covered calls, but your downside is unlimited. A single bad day in tech could wipe out months of premium income. And with daily options, you're exposed to this risk 250 times per year instead of 12. But there's also the leverage multiplication problem. All three DayMAX funds use 25% leverage on top of their daily option strategy. So you have leverage exposure to stocks that are already volatile with covered calls that expire daily, generating income that's not guaranteed. When markets crash, leverage amplifies losses while the daily option strategy provides zero downside protection. You could see catastrophic losses much faster than with traditional monthly covered call funds. And here's the frequency trap that most investors just don't really understand. Just because you're collecting premiums 250 times per year doesn't mean you're making more money. Option premiums adjust for time to expiration. A daily option will have much lower premiums than monthly options because there's less time for the stock to move. The total annual premium collected might be similar, but you're taking on the risk of being wrong 250 times instead of 12 times. So there's also operational complexity risk. Writing options daily means the fund managers need to make correct decisions every single trading day. Traditional covered call funds make these decisions monthly. The potential for human error, system failures, or poor timing increases exponentially when you're operating at this frequency. One bad algorithm or system glitch during volatile day could cause massive losses. And then there's the liquidity risk during market stress. When everyone wants to exit during a crash, these funds might not be able to efficiently close out their daily options positions. Unlike monthly options that have more liquidity and time to manage, daily options during panic selling could force the funds to take catastrophic losses just to meet redemption demands. But there's also the yield sustainability illusion. Those 17.5% to 20% yields assume market conditions remain favorable for options writing. During low volatility periods, daily options premiums collapse to almost nothing. During high volatility periods, the underlying stocks become so unpredictable that the option income gets wiped out by capital losses. The yield you're seeing now might not exist in 6 months. And if you want to calculate your potential returns or lack thereof returns from these ETFs, check out the free investment profit calculator in the description and first pinned comment. Now, instead of waiting for a full month between distributions like traditional covered call ETFs, these pay every 2 weeks. That is 26 payments per year instead of 12, which could really smooth out cash flow for income-focused investors. So let's get back to the positive. This more frequent payment schedule means you're getting money every 2 weeks rather than having to wait 30 plus days between distributions. And that could really help out a lot of people. So for retirees or anyone depending on investment income, this could significantly improve cash flow management. But here's what they don't tell you about these frequent distributions. More frequent payments often mean each payment is smaller and less predictable. With monthly distributions, you have a better sense of what to expect. With bi-weekly payments from a daily option strategy, your income could vary wildly from payment to payment based on how well the daily options writing performed over those 2 weeks. And the 0 day to expiration strategy is fascinating. Traditional covered call funds write monthly options and wait 30 days for them to expire. DayMAX funds write options that expire the exact same day, allowing them to collect premiums much more frequently. When volatility is high, these daily options can generate substantial premiums. When it's low, these funds simply adjust and continue writing options daily. This flexibility could potentially lead to more consistent income generation compared to traditional monthly strategies. However, this daily flexibility also means daily risk. Every single trading day becomes a potential disaster if the markets move against this strategy. You're essentially gambling 250 times per year instead of 12 times per year, and the law of averages suggests you're going to be wrong more often. So I'm running a live experiment with 2 out of the 3 of these DayMAX ETFs as part of a 6 ETF Battle Royale. So make sure to check that out. I've invested $1,000 split between the 6 different experimental covered call ETFs, including SDAY and QDAY from this DayMAX series. The plan is weekly updates for the next month, tracking their performance. And whichever ETF wins might get a $10,000 allocation in my main covered call portfolio. So this $1,000 experiment could directly influence a much larger investment decision. But let me be completely honest about the concerns. These funds launched in July 2025, so there's zero track record. I'm essentially betting on Hamilton ETF's expertise and this new zero DTE strategy working as intended. The daily option strategy is fascinating in theory, but market conditions can change constantly. When volatility is low, these daily options might not generate much premium. When it's high, the underlying stocks could become more volatile too. And remember, all 3 funds use 25% leverage, which amplifies both returns and risks. This isn't a conservative income strategy. It's an enhanced yield approach that comes with significant volatility. We're talking about leverage funds using untested daily option strategies on volatile underlying assets. The potential for catastrophic losses is very real. So these aren't for everyone. If you're building wealth for retirement and are 10 plus years away, stick to diversified index funds. DayMAX ETFs are for investors who need current income and can handle significant volatility. They're for people who understand that these enhanced yields come with enhanced risk and who can afford to lose their entire investment if this experimental strategy fails. Now, here's the reality about return of capital with these funds. Because they're so new, we don't yet know how much of their distributions will come from actual option income versus return of capital. With traditional covered call funds, a significant portion often comes from ROC, meaning you're getting your own money back. With daily option strategies and 25% leverage, this problem could be even worse. You might be celebrating high yields while your principal slowly disappears. And then there's the NAV erosion risk that's amplified with daily strategies. Traditional covered call funds see NAV erosion over time, but daily options writing could accelerate this process dramatically. Every day, the fund writes options that expire worthless to them. They're potentially giving away upside while keeping the downside risk. Over 250 trading days per year, this could create a steady drain on the fund's actual value. But there's also over optimization risk. These funds are trying to squeeze every possible dollar of income out of their holdings through daily options writing and leverage. When these strategies become this complex and aggressive, they often work great in specific market conditions and fail catastrophically when conditions change. We've never seen how zero DTE covered call strategies perform during a real bear market or market crash. Hamilton's DayMAX series represents a genuine innovation in Canadian covered call strategies. The semi-monthly payments and daily options approach could potentially generate higher yields than traditional monthly covered call funds, but they're experimental, leveraged, and they come with all the risk that entails. These yields aren't guaranteed and they will fluctuate based on market conditions and options premium generation. So I'm currently testing SDAY and QDAY live with my real money. I'll be sharing the results with you in weekly updates. So whether you're considering this for your own portfolio or just curious about how innovative ETF strategies perform in real market conditions, this experiment should provide valuable insights. But remember, I'm testing with money I can afford to lose completely. This is experimental money, not core portfolio money. The $1,000 I'm risking represents a tiny fraction of my overall wealth, and even the potential $10,000 allocation would be a small speculative position that I would be comfortable losing. So make sure to watch my latest video on my current 100K covered call portfolio to see how I'm generating that $2,243 monthly. And then check out the weekly 6 ETF battle series to see how QDAY and SDAY are performing against the competition in real time. And I know I've listed a ton of cons in this video, but only because personally, I like to know every way something can go wrong when I'm investing. I notice when I prepare for the worst, the best always happens, because these DayMAX ETFs could represent the future of covered call investing in Canada, or they could be a lesson in why sometimes traditional approaches work best. Either way, we're about to find out together, and I'll document every step of this in the experiment. So basically you can learn from my mistakes and my results without risking your own money. So check out those videos and check out these two videos for more investing tips. Bye guys.